Check, 1, 2. Hello. Thank you so much for joining. Can everyone hear me? I really appreciate it. Today, in this session, we're just going to talk about options Greeks. I know most of you guys are new to trading, especially when it comes to options, and I'm pretty sure most of you are familiar with trading stocks until now and just starting out to trade options here. If you're a beginner, knowing options and the Greeks in options is very, very important. Let me tell you why. So let's say like you are new to trading options, and if you have traded shares until now, if you have like 10 shares in, let's say 100 shares in a stock, you will know how much money you will be making if the stock goes up $5, and you will know how much money you'll be losing if it goes down $5, right? So let's say you have 100 shares and the stock goes up $1, you'll make $100. If it goes up $2, you'll make $200. If it goes down $1, you lose 100. If it goes down 2, you'll lose 200, and vice versa. It just keeps on going. So you have a way to calculate the amount of money you make and the amount of money you lose, right? But when it comes to options, there is also a way to do the same. That's where the Greeks comes in. For every single strike you pick, for example, if you're trading SPY and if you took puts today at the open, let's say you took 398 puts when the market opened, right? How to find out how much money you'll be making, and how to find out, like, for every dollar move to the downside in SPY, how to find out how much money you'll be making or losing. That's where the Greeks comes in. That's where the Greek steps in. Every single option strike tells you the amount of money you lose or amount of money you make for every dollar move. And there are other factors as well which determines that price point. So every single option strike has this detail. So we'll go over every single one of them. There are 4 different types of Greeks, 5 in particular, but the 5th one is so unimportant that no one even uses it, or no one even keeps an eye out for it anymore. But we'll talk about that as well. They're all like delta, gamma, vega, theta, and we'll also talk about implied volatility, because I got a lot of questions asking what is IV and what is IV crush and all those stuff. We'll talk about that as well. So the first things first. As I mentioned before, we got to understand what Greeks actually are. So when you pay, like, let's say $200 for an option, that $200 is calculated based upon a lot of different factors, right? So that information on how much the contract moves for every single dollar move in the options, and how much your contract loses for every day you're holding it. You must have heard about this Theta decay, you must have heard about this delta, everything before. So those Greeks determine the price moves in the options premiums. And the shares, this is options. So I already mentioned before, with shares, you know how much money you'll be risking before even entering the position. You got to be in a position where, like, you know the same when it comes to options as well, so you can define your risk before even entering the trade. So what do I mean by defining the risk? For example, like, I'm seeing a lot of questions, especially from the beginners who just started trading options, saying that, should I cut it? My position is up this much. Should I take profits here? My position is down this much. Should I take profits here? You got to know all these levels even before entering the position. Knowing the options Greeks actually lets you assign where to secure profits or where to set your losses, because you will at least know how much your contract moves when the SPY, for example, let's say you shorted SPY, or you bought puts on SPY at 398, right? So how much your contract will be. Like, in order to have an estimate on where your contract will be when it gets to 394, you need to understand the basics of the Greeks. So first things first, we'll start with different types of option Greeks. As I said before, we are going to cover 4 of them, but I will also talk about the 5th one. First things first is delta, theta, gamma, and vega. And there is another one called RHO. We call them rho, We'll talk about it at the end of the slide because it doesn't even matter. So first one is, like every time whenever you see some trader talking about all these, just know that they're talking about the Greeks in the options. The delta, theta, gamma, vega. You must have heard these terms before if you've been trading along. You must have seen these terms in the chat being used multiple times, that I took this contract because it has this much delta and it has this much theta. You must have heard these terms, especially Alva uses this all the time. If you're a part of Saints Discord, he will be like, there is a lot of intrinsic values, extrinsic value. What are all these? That's what we're going to see in this video. First, we will start with delta. If you joined this stream from the beginning and was hearing my ranting from the beginning, I must have said something about stocks versus options. Like if you have 100 shares of Apple, for every dollar move in Apple, you make $100, right? For every dollar move to the downside in Apple, you lose $100. When it comes to options, that's all delta tells you. How much money you will be making or losing for every single dollar move in the stock price. So let's go over an example, right? So let's say like you have Apple $150 calls. Apple $150 calls, and let's say it has a delta of 0.60. And also one thing to note, you can see all these details if you select your options in Robinhood or Webull or any brokerage you use. If you select the options, and once you select the options, there'll be a small green button where like it says bid and ask price, right? When you click over there, it'll gives you a detailed explanation of what the Greeks are for the particular strike which you're picking, right? So in every single Greek will be mentioned like 0.60, 0.45, 0.10. Everything will be in the decimal terms. So when it comes to options, you always got to multiply that value by 100. That number gives you the amount of money you'll be making or losing. For example, if the delta is 0.60, if you multiply that with 100, it'll be 60, which means that option contract will make or lose $60 for every single dollar move to the upside or to the downside in the Apple. For example, like if you got like 150 strike call option in Apple which expires in a week and it has a delta of 0.60, it tells you that if Apple goes up to 151, you will be making $60. If Apple goes up to 162, you'll be making another 60, like $120, like something like that, like $60 for every dollar move. If Apple goes down to 149, you will lose $60. If Apple goes down to 148, you'll lose another 60. So by knowing what the delta is, you will have an estimate of how much money you will be making or losing if a stock gets to a certain level. So if Apple goes, let's say your profit taking target on Apple is at 154, right? So before even entering the contract, you will understand like, okay, I'll be approximately making $240 because like you just multiply 60 into 4, which will be like 240 and change. And this is like a basic way. And there's also one more thing to note. It is not a constant value. This 0.60 which you see, the $60, it's not going to keep staying at 0.60. It's going to keep changing. It's going to increase or decrease based upon the movement of the stock. If you got call options and the stock price is pushing up, the delta will push up alongside with it. If you have a call option and the stock price is pushing down, the delta is going to go lower alongside with it. So something to keep an eye out for. We'll talk more about how all the Greeks are correlated, and you will understand this even further as we move towards the end of this video. So if you guys have any doubts on the Greek called delta, let me know in the comments section. We will talk further more about delta in the upcoming slides as well. So if you guys have any questions, let me know. Alright, so if there is none, we'll go to the next, which is gamma. What is it? If you have traded in 2020, you must have heard these terms like short squeeze, gamma squeeze, remember? Like these are all the most used terms during those times, especially when that AMC, GME, BBIG, all those manias were happening. This is like the most common term used out there, which is gamma squeeze, short squeeze. What does all that mean? Like, what does the gamma squeeze has to do anything with the options price? If you especially traded those AMC calls or GME calls, you must have noticed one thing. Those contracts move insanely quick, especially when you have out of the money options. Why is that? Why some options moves like crazy, just like that, up and down, like instantly quick? Why those deltas appreciate in value while the others moves like a snail? It just goes on slow. It doesn't pick up steam. Gamma is the culprit over there. So I told you before, right, like the delta is not the constant value. It changes when the stock price moves in your favor. How much it changes is determined by this gamma. Delta tells you the amount of money you make or lose for every single dollar move in the stock price. Gamma tells you the amount of money that's been added to the delta for every single dollar move in the stock price. It all relates to the delta at the end. Delta tells you the amount of money you make or lose for every single dollar move in the stock price. Gamma tells you the amount of money that will be added or subtracted from the delta for every single dollar move. I'll give you an example. If it's all overwhelming, trust me, it's going to make sense at the end of the slide. If a stock moves by $1, all right, the gamma will just add the value to the delta. For example, like we'll stick with that 150 strike in Apple. Let's say you spent like $120, 1.20. We're going to talk in options terms. 1.20 refers to $120, all right? You spent $120 on a contract that has an initial delta of 0.50 and a gamma of 0.06. I mentioned before, whenever I say 0.50, it means you're going to make or lose $50 for every single dollar move. And the gamma is 0.06, which means for every single dollar to the upside, $6 is going to be added to your delta. All right, so let's say Apple moves up like $1. Let's say it moves to 151 after you're getting this contract, right? When it moves up to 151, the $120, the $50 delta will be added to it. So currently, your current same premium will be sitting at somewhere around 170. And then you're going to add your gamma to your delta, which will be your new delta. It'll be like $156 instead of 50. So if Apple goes up to 152, you'll be making $56 for every dollar move instead of the same $50 before. And now if Apple goes up, $12 will be added. So technically you'll be making $68 for every dollar move. So the gamma and delta are related. The delta and the stock price are related. It's like a train. Everything will be related. Everything will be working hand in hand. So to recap, the delta tells you the amount of money you make or lose for every single dollar per move in the stock price. Gamma tells you the amount of money that's going to be added to the delta for every single dollar move in the stock price. All right, so let's go through the question. So can you talk about how delta relates to the probability of trade being successful? All right, so let's say you enter a trade, all right, and it has a delta of 60. So basically what it tells you is you have 60% chance of that trade closing in the money. You have 60% chance for making at least $1 from the trade you just entered. So if you have, if you open a trade, let's say it's the same 150 strike, if it has a delta of 0.50, which is 50, you have a 50% chance of making at least $1 from this strike price, from this trade, whatever you open. So if you open like 140 strike deep in the money, and it will be usually having a delta of like, let's say 80 to 90, it just tells you you'll be having a probability of at least making like $1, 80 to 90% probability of making at least $1 from the trade. So that's why the delta has usually been used as a probability indicator. It doesn't tell you how much, doesn't give you the probability of how much money you'll be making. That probability is only accounting for at least $1. You'll be at least making $1 from that option the probability is given by the delta. In this example, as you can see in the screen, this 150 strike has 50% probability of you making at least $1 from this trade. That's all it is. It's simple as that. It's not much complicated. When you see the delta, you'll see that, okay, I'm having this much probability of making at least $1 from this trade. That's it, done. So now we know delta, now we know gamma. The gamma squeeze, yeah, let me talk about that as well before I move on to the next, the theta. We'll talk about gamma squeeze first. What causes gamma squeeze? What effect does it have on the options contract? So when the stock price moves like real fast, real quick, let's say like the stock jumps like $10 to $15 every single minute, right? These gamma, which you see right over here, this is going to explode. It's not going to be 0.06 anymore. This is going to be way higher, and it's going to oscillate real quick. What will happen if gamma oscillates? Your delta oscillates. The amount of money which you'll be making for every single dollar move keeps going up and down in a crazy level. When this pushes up in a crazy high levels, it's going to push the delta up crazy high, which in turn tells you the amount of money you'll be making or losing for every single dollar move. So when this happens in a real fast pace, we call this gamma squeeze, because like it's squeezing out every single gamma which is there in that options contract, which is in turn boosting the delta, which in turn makes you shit tons of money real fast, real quick. Alright, so we have another question. But delta can vary based on how far it goes up. Correct. That's where you've got to keep gamma in mind as well. When I said in the previous slide, it's not a constant value. It increases or decreases depending on the price if it moves towards or against your entry. So if you get a call option and if the stock price goes up after your entry, your delta is going to go up alongside with it. If its stock price goes down, your delta is going to go down alongside with it. This is for call options. For puts, it's the opposite. The delta is going to go up if the stock price is going down, and if the delta is going to constantly go lower if the stock price keeps going higher. This is for puts. So how much higher it goes or how much lower it goes, in order to calculate that, that's where the gamma steps in. It tells you how much money will be added or subtracted from the delta. Because with stocks, as I said earlier, it's easy, right? Like if the stock goes up $1, you'll make like $100 if you own like 100 shares. But with options, it's a whole another mathematical interconnected bullshit which has been going on. That's why it's very important to learn the Greeks. At least it gives you an estimate of how much money you'll be making or losing, right? So at least you'll have an idea on why your contract moves, especially if you're a beginner who's just stepping into the options. So now we got like delta covered. Now we got like gamma covered. We're gonna go into the next real important Greeks, which absolutely destroys half of the new trader population who doesn't understand options, that is theta. If you are in Discord for a while, you must have seen these questions like a lot of times. I've been like holding this option, the stock price is going up, but my premiums are still down. I don't know why. If you have heard this before, let me know, because I have heard it like more than 100 times still now. They buy like way out of the money strike and the stock price will be going up, but they'll still be wondering why they're not making any money out of it. Well, the culprit is, one of the culprits at least, is theta. It actually tells you, it's pretty simple. Let me put it this way. If you lease out a car, right? Like let's say you lease out a car, or like you buy a car, let's assume. The more you drive it, and let's say you sell the car like after like 3 years, and you bought the car for, let's say, $20,000, and after 5 years, there is no way in hell you're gonna sell it for the same So technically, the value of the car deteriorates the more you drive it, right? The more kilometers you drive your car, the more the value of the car deteriorates as the time passes. It's the same concept when it comes to your options contract as well. Regardless of what options you hold, you are going to see some deterioration every single day as it passes by. How much it will deteriorate? That's what Theta tells you. So to put it simple, let's go back to our same 150 Apple example, right? So let's say like it has a theta decay of 0.24. Every single day you hold on to your this option strike, you're losing $24. That's all it tells you. Every single option strike has its own delta, has its own gamma, has its own theta. Every single strike, they have their own individual Greeks. Always keep an eye out for them, because like the theta, especially for the short-term options, because like most of you folks which I see in the Christians Discord are trading with 1 day or 2 day expirations when it comes to SPY. So the theta tells you the amount of money you'll be losing every single day, amount of money the contract deteriorates on every single day from your options premiums. So if you spent like $150 and you have a theta of 24, you can have an estimate of how much money you'll be losing. Let's say if the stock is just trading flat and it doesn't even move. If it's at $150 and you bought it, the Apple just stays pinpoint at 150, you're going to lose $24 every single day leading into the expiration. Simple as that. So let's go with the question. Every option I bought. All right. Now, once you learn this, then like you're going to make better decisions on strike selections. It's going to make sense. All right. So, but delta can be very based on how far it goes. I already answered that. Higher delta is good for day trading. Well, technically, it depends. When you're swinging a contract and the stock price barely moves, and one thing to note, if you want to pick a strike with a higher delta, it's going to be expensive. They're going to charge you a lot. I'll tell you why when I go over the intrinsic and extrinsic value, and especially if a strike price of higher delta automatically have lower theta, and I will explain why higher delta contracts usually have lower theta. You can just check it out yourself. Go to Robinhood, and then like see any option contracts. All right, let's say what SPY is trading at what 393 something. Okay, so go like 1 month out and check the call options for 300 strike. Yes, I know SPY is trading at 393. Check out the call option. Let's say like 350. All right, look into 350 calls expiring 1 month out. Check the delta in that. I'm pretty sure it's going to be somewhere around 70 to 80. And check out the theta. It tells you the amount of money you'll be losing on a day-to-day basis. That one. And now go to the same 400 or 450 or like 420 or anything out of the money. Let's say like 420 calls, 4 means. Go to 420 calls and see the delta. The delta is going to be pretty low. Now check the theta. The amount of money which you'll be paying will be high when it comes to in the money options, but the effect of theta decay, you won't be noticing a lot. Lower theta is good? Yeah, of course. Lower theta is pretty good because like you're not actually like losing money just for holding it. So yes, lower theta is good. And I will tell you how it impacts. There are two different sections when it comes to options. There is something called as intrinsic value. There is something called as extrinsic value. So we're going to cover that in the next coming slides. The theta only kicks the extrinsic value. The extrinsic value is also called, we call it as time value. So the theta subtracts the time value every single day. So by the time of expiration, this time value, the extrinsic value will be 0. You'll only be holding your intrinsic one. So is theta lost by the day or minute? So tech depends on your expiration. If you buy like a 1 day expiration options, like say the options which expires on the same day, you are going to see the deterioration every single minute, because by the end of your expiration, if the contract is out of the money and you spent like $150, let's assume you got like 400 calls today morning on SPY, and SPY never got to 400, so that contract should go to zero by your expiration. So the theta decay is gonna be there every single minute, ripping away the premiums from the contract so they can park it at zero by your expiration. Why when I try to put a stop loss it gives me an alert? So wait, when I try to put a stop loss it gives me an alert, so I can, because it will trigger my sell. Well, that is for, I will answer this question in the chat. It doesn't come under the scope of this session. I have a question regarding the contracts. For example, if SPY broke down 400 and we are buying puts, how do I pick a strike price and a date? All right, this is a good question. Now we are talking about the application side of things. So now we know the basics, right? Like there's one more very important Greek which we need to talk about, that is Vega, but we know the basics. Delta is the most important Greek to know about. And we already spoke about theta. Theta tells you the amount of money which deteriorates. Gamma tells you the amount of money that's been added to the delta. Now, let's say like the SPY opened at 400 and let's say SPY broke down 400 and we're buying puts. And if you're swinging it, let's say, all right, so I got into this 404 puts like 2 days back and I'm still holding on to it. The reason why I picked 404, when I picked 404, SPY was trading at around 403 and change, and that put expires like 2 weeks out in the December. The reason I went for 404 instead of going to 380 or 390, because one, I don't want my options contract to decay like to a crazy amount when the drop happens, or when SPY is just trading flat for the entire day. That's the main reason. Two, you need to have at least some good amount, you need to make at least some good amount of money every time SPY drops $1. The 404, when I got it, it had a delta of around $57, which means like for every dollar drop in SPY, I'm gonna be making 57. And if SPY broke 400 and it's gonna drop lower, I'm just gonna keep making a lot more money as it keeps going to drop down. So the delta side of things, I need to have a good risk to reward for the money which I've spent. And the theta side of things, I don't want my options contract to deteriorate like to a crazy extent just because the SPY is trading flat for 1 day. So if you consider all these things going somewhat in the money, which is like SPY is trading at 400, going for like 404, like 1 month out or 45 days out, not only gives you the ability to make more money for every single dollar drop, but also gives you a lot more time value to your options contract, because like even if the theta decays, there's always this intrinsic value which is going to help you save those contracts. We will talk about intrinsic and extrinsic value in the next slide, but the main reason you got to go for in the money, there are reasons to go for out of the money as well, but if you're going like a month out or something, if you're swinging it, it'll be better to go for in the money. Give yourself some time for the contracts to do its thing, and also make sure that the theta doesn't eat away your contracts for every day you hold it and every day the SPY trades flat. For swings, always choose in the money contracts. By in the money, what I meant is, let's say if a stock price is trading at 39, let's say SPY was trading at 400, anything above 400 in puts is in the money. Anything below 400 in puts, it's out of the money. All right. For calls, it's the opposite. Anything below 400 in calls is in the money. Anything above 400 in calls is out of the money. So how do you gauge how far it'll drop? Yeah, that comes under technical analysis. So with TA, you got to analyze the price. The price analyzation has nothing to do with the scope of this video. But once you analyze the price, and let's say like you're saying once it drops under 402.60, If it drops under 402.60, the next stop on SPY is somewhere around 394 or 394 or let's say 390 to the downside. So you have an idea now. So SPY, if 402.60 is broken down, the SPY might get down to 394 to 390. When you have an idea, give yourself some time. Let's say like now, we're coming to the execution side of things. The analysis side is over, the execution side begins. So when SPY broke down under 402.60, you go to the 404 contracts, give yourself 1 month out, check out the delta, check out the theta, check out the gamma. You're gonna first jot down the plan. The 404 strikes, you'll understand how much money you'll be making for every dollar move to the downside. And also you'll also be having a brief idea on if SPY did get down to 394, how much money you'll be making. Now let's say you put your stop losses at closing candles above 404. Now you also know, just so now you know like how to calculate the delta, how much money you'll be making or losing. You'll understand how much money you're actually risking. Let's say if SPY goes up to 404 and you have a delta of like negative 50 in puts, in when it comes to like, okay, one more thing to notice. In calls, the delta will be positive. In puts, the delta will be negative. So let's say like if you got like 150 put in the same previous option, all right? If this is a 150 put, you'll see the delta of minus 50. But the explanations are still the same. If it goes down $1, it's going to add the gamma value to it. And if it goes down another $1, it's going to add the gamma value again to it. The explanation is still the same. It still tells you the amount of money you make or lose, but the delta in puts is going to be negative. The delta in puts on delta on calls is going to be positive. But can you pull it before the expiration date? Yes, you can sell your options anytime you want. So let's say like I'm going to sell my options tomorrow. It's like the 404 puts, whatever I got. So I will sell it tomorrow. And you can pull it out anytime you want. You don't have to hold on to them to the expiration. Let's say like I'm holding on to it until expiration, and they did expire in the money. Let's assume that they're going to exercise and they're going to sell my 100 shares of SPY at 404. I don't want that to happen. So we'll talk about exercising, assignments, and everything in another slide. So we can go in depth on what will happen if you let your contracts expire and stuff like that. But for now, these are the basics of Theta. Every day you hold your options, it deteriorates in value. There is this important point here, some deteriorates more than other. In the next slide, we're going to talk about what are those some. Which contracts deteriorates more, which contracts deteriorates less. This is where intrinsic and extrinsic values comes in. So the options premiums, whatever you see, if you open your options contracts and you'll see like $300, $400, $500, like all the money side, whatever you see, those are nothing but two things glued in together. We call it intrinsic value and we call it extrinsic value. All right. So if you're talking about calls, let's say you bought calls today before close, because SPY was hitting the support at 391.96 and you wanted to go long. By long, I mean you want to buy calls and you pick the 390 strike. So 390 strike will be having, let's assume that the 390 strike has a delta of 60 and the 390 strike has the theta of like 0.40 and the 390 strike has a gamma of 0.05. All right. So this 390 strike, and you paid like around, let's say $320 to it. In this $320, that 320 will be split into two. Intrinsic value and extrinsic value. The theta decay, it doesn't touch the intrinsic value. That's why when people say in the money options are safe, what they mean is if those contracts expire, at least you won't be losing 100% of your money. Any in the money contracts, and let's say like you buy the 390 calls and you have, if you spend like $320, the break evens on those should be somewhere around $393.20. Let's say SPY is just trading flat for the entire week from like 390 all the way to 394. It doesn't move at all. And it closed the week at 392 and change, which is below your break even. But the good thing here is, since you're in the money, you won't be losing your entire $320. You will only be losing the extrinsic value of the $320. Let's assume that it's somewhere around $70. So technically you'll only be losing $70 even if it closed under your break even, because your contract still expired in the money. But let's assume that you got the 400 calls when SPY was trading at around, SPY was bouncing from the support. Out of the money options doesn't have any intrinsic value. It's just pure extrinsic. That's why when they expire, it always goes to 0.01. It always expires at 0. Because they don't have any intrinsic value. It's purely extrinsic. And if it did expire out of the money, you're going to lose it all. So when people say it's safer to buy in the money options because it has a lot of intrinsic value to it, this is what they mean. If you're swinging, I mean, like few minutes back, I was suggesting a user like in the money options are better. This is also another big reason. Even if the trade didn't go in your favor, let's say like the stock was just trading flat for the entire month, which might be our bad luck, and the stock didn't move at all. Since you got in the money, you won't be losing a lot of money through the theta decay, which is the extrinsic value decay. Even if the entire extrinsic value options or value is gone from the options, you'll still be making a lot of money. I mean, you won't be losing a lot of money. You won't be losing your entire position because the intrinsic value is still going to keep the contract held up. So when the explanation for some deteriorates more than the others, out of the money options deteriorates more compared to that of the in the money options, because in the money options have intrinsic value and extrinsic value. Out of the money options only have extrinsic value, and the theta targets only the extrinsic value side of things. So I understand that this is kind of getting a bit complicated, but take a step back, play back the video and listen to it again. I'm pretty sure it's going to make sense. And the more you trade, the more now when you see the options contract, you'll understand, oh, okay, the delta is this much, I'll be making this much money. So the gamma is this much, so every time a stock moves $1, this gamma value is going to be added to this delta value, and I'm going to be making more and more and more money as the stock price keeps going up. Okay, so this is theta. I'll be losing this much money for holding this contract for every single day. Okay, I'm picking in the money option, so I won't be losing 100% of the premiums as long as the stock closes in the money. If it's out of the money options, you know the risk. The risk is your contracts expiring at 0 if the trade didn't work out, because it's purely based upon extrinsic value. So hope this slide makes sense, and now we are gonna jump into the most important thing over there. It takes time to digest. Yes, it does. Sorry, I messed it up. I meant to ask why when I try to put stop loss, it gives me an alert saying it can't be placed because my sell order will activate immediately. Oh, okay, you must have put the stop losses above your limit price then, that's why. If the stop loss is above the limit price, and they're gonna fill you in with the best price possible immediately as soon as you sell it. So you got to lower your limit. Let's say the contract is going for $150 and you put the limit price as $180, they're going to immediately sell your contracts for $147 or $148 because that's the current price of the option. So you got to lower your limit price, and when you do that, it works. But as I said before, this session is not about stop losses. It is all about options Greek. So if you have any questions based off of that, let me know. I'll be happy to answer. So, how many of you played earnings and then got absolutely destroyed? I mean, not because the stock moved the other direction, destroyed even after the stock moving in your direction. For example, like you got calls on let's say Apple for earnings, and let's say you got like 160 calls, and Apple goes up like $3 or $4 after earnings. And even after Apple gaps up, when the market opens, you're still down on your call options, though the Apple gapped up $4. Same with the puts. You buy like 150 puts and Apple goes down like $3, and from like you got like 150 puts, and let's say Apple dropped from 160 to like 155, market opens and you're still down on those 150 puts, even though the stock gapped down like $5. Especially if you traded earnings, you must have seen these effects more often, and you must have heard this term called IV crush. Don't trade earnings. If you trade earnings, your contracts is going to be crushed because implied volatility is going to drop. So what is this implied volatility? That is what we're going to talk about in this slide. Very important factor determining the options premiums. Really, really important. So when you do something like, in order to give an example, let me give you an example to explain what IV actually is. If you start a business, right, let's assume that you started a business, and before starting it, you'll be having certain expectations. Let's say like by the end of first year, I'm going to be making this much profit. By end of second, let's not even year, let's say month. By end of first month, I'm planning on making this much profit. This is my profit strike. By the end of second month, I'm going to be making this much profits. So you have the assumption on how much money you're going to make by end of 1 month. Same with the stock markets. Stock markets have expectations on the particular stock as well. And they price that expectations into the options premium. So like there is a saying, like, let's say if there is a salmon shortage in the Pacific Ocean, market is gonna price in everything. Like let's say like there is a pollution in there is a oil slippage in the Pacific Ocean, stock market is going to price in the salmon, price in a hike in the salmon price, or like the fish which is like around that area, whatever the futures of that fish which is around that area and that oil spill, market is going to price it in. So market is always forward looking. So market prices in every single thing before even you realize it happened. So only time you get money is like the times you are early, like for example GME, when no one saw it coming, right? So no one saw it coming. People who were like early to the boat made shit tons of money. But most of the time, market always prices in things. That's what implied volatility tells you. Implied volatility tells you the percentage of the move expected in the stock with the next 30 days, like how much the money has been priced in. That percent is been priced into your options premiums, your calls or puts or whatever it is you buy. Market's expectations for the next 30 days, it's going to be there in your option strikes, especially during earnings or during uncertain events or some unknowns, let's assume, right? So let's say we have earnings tomorrow, option and markets will price in like $5 to $6 move. That's what surprises me every time when people play earnings, because we all know the stock is going to either gap up big or gap down big time. Do you think market doesn't know that? It already does. That's why the options are relatively expensive on the week of earnings. If you go and check out the earnings, like let's see what reports earnings. Like go to any company which was about to report earnings next quarter, right? Check out the cost of the premiums for that month or for that week. It is going to be relatively expensive compared to that of the other days, because the markets already price in the estimated moves for that particular day. So when that expected move doesn't happen, it's going to rip out all the premiums which has been priced in already, so it can be reverted back to the mean. That is what we call it as IV crush, and that's why, let's say like you buy calls or puts on the earnings and then the stock just trades flat, and the next day when the market opens, even though the stock didn't move or do anything, your contracts are still going to be down like 60, 70, sometimes even 90%. The stock must have not even moved. That is because the market has priced in like $8 to $9 move, but they didn't get it. So once the uncertainty becomes certain, they rip off the priced in options premiums, and they're going to give you, okay, this is the real premiums right now. We priced in this much, it didn't work out, so we're gonna take it away from you. So simple as that. So IV tells you the market's expectations on that particular stock for the next 30 days. All right. If the implied volatility is crazy high, your option premiums are going to be crazy high as well. Something to note is shorter dated options, for example, like let's say weekly options, are more susceptible to IV crush compared to that of the longer dated ones. So the longer dated options will be having less impact to the implied volatility compared to that of the shorter dated options. You can clearly see when you go to like any weekly options, any weekly option chains in your options contract and check the IV on those. Those IV is going to be comparatively less to that of the longer dated options. So there is something called two types of volatilities are there in the markets, right? One is realized volatility, the other one is implied volatility. So the example which I gave you, the business example, that you're forecasting that you will be making like this much percentage of money by the end of this month, remember? That is your forecast. After the end of the month, you will be making some money. That's like, you know, the unknown right now. That is the realized volatility. So let's say the market price in $10 move in Apple by end of this month, and Apple only moves $5. So that $5 move is what the realized volatility is, the move that actually happened. And the $10 move is what implied volatility is, the market priced in $10 moves, but we only got $5 moves. Those contracts are going to get destroyed regardless with the IV crush because the expected move didn't happen. Simple as that. What happens when OPEC controls the production? Nah, that has nothing to do with implied volatility. I mean, like, news events does impact the oil stocks and everything, but the concept is still the same. Markets always price in the potential worst case scenarios or the best case scenarios into the premiums of calls or puts. For let's say like what's worst can happen in the OPEC meeting. They might say that they're not going to produce more oil, they're not going to supply a lot of oil to other countries. If that happens, what's going to happen to the oil price? It's going to shoot up. So when oil price shoots up, the energy stocks, the XLE is going to go up alongside with it. So markets will price in, that's the positive scenario for the energy stocks. So they're going to price in certain amount of value into the call options. So what's the worst case scenario? They say like they're going to supply more, which is going to bring down the oil price and which is going to bring down the prices of the energy stocks. And they're going to price that in as well into the puts. So both are going to be priced in regardless. The point is markets prices in everything, known, unknown, everything is going to be priced in regardless before even you know it. So that's why playing news related events is kind of a bit dangerous because, well, the market already knows. Simple as that. So if something happens like geopolitical stuff, if some risk is going on, well, you'll see a big sharp turn down. Those are the times where like it even surprises the markets, and those are the time where you make a lot of money because those aren't priced in. Something sudden happened and there you go. Boom. So that's what implied volatility is, and these are the dangers of playing earnings as well. So like you don't want to mess around with these. How to find out how much money you'll be making or losing when it comes to implied volatility. So let's say like SPY contracts have 21% IV, especially the shorter dated ones. Let's assume if you go to like SPY options and see the implied volatility, it will be under IV in the Greek section. So if it's 21, let's say like tomorrow the market open and that drops to like 20. How much money you'll be losing in your options contract? Or let's say it goes up to like 22. How much money you'll be making in those option contracts? That's where Vega steps in. Vega tells you the amount of money that will be added to your options premiums or removed from your options premiums for every 1% move in implied volatility. Let's go back to your same 150 call as an example. Let's say it has an IV of 49% and the delta of those contracts are 0.70. and you pay, like, let's assume you pay around $150 to that, and the Vega is 0.05, which means for every single % move in implied volatility, and let's say if IV goes up to like 50%, the same contract, what you spend like $150 on, is going to be worth now around $155, even if the stock is just trading flat. So let's say the IV goes up to 51%, the Vega is going to add up. The same contract is going to be worth $160. That's what happens during earnings as well. If you play like pre-earnings, and if the stock is going against your directions, but your contracts are still going to push higher, you must be confused, like, wait, I got calls, but the stock is going down, but my contracts are still going up. The answer why is because the implied volatility is surging, which is actually keeping your contracts alive. And how much you're making or losing for every single person for jack up in IV, that's going to be mentioned with Vega. So, to conclude, it's pretty simple. Take a note and write it down. Like for delta, amount of money you make or lose for every single dollar move in the stock price. Simple, like no complications, nothing. Just you make, like, for delta is 60, you make $60 to the upside if the stock price goes in your favor, or you'll lose $60 if the stock price didn't go in your favor. Now we'll connect all the trains together now, shall we? Now, gamma tells you the amount of money which will be added to the delta for every single dollar move in the underlying. By underlying, I mean the stock. It's like, for example, like if the 150 call has a gamma for 0.06, for every single dollar move, the delta is going to go up by $6. The gamma tells you the amount of money that's been added to the delta for every single dollar move in the stock price. Vega, we just spoke about it. The Vega tells you the total amount of money that will be added to the overall options contracts for every single % jump in IV, or the amount of money that you'll be losing for every single % dump in IV. So this is how you play the earnings. Like this is how you can estimate, like let's say like the contracts will have like 160% IV in the calls or puts, and you got to assume the worst case scenario where, like, let's say it dumped to 80% the next day morning, how much money you'll be making or losing. You got to check out the Vega. Check out the Vega, multiply it by 80. That's how much money you'll be potentially losing if the stock opens flat. Simple as that. Theta. Theta tells you the total amount of money that will be taken away from your overall options premiums per day. We already spoke about this. Theta decay for single date expiration options is gonna be on real-time basis. It's gonna be every single minute you'll see the options deteriorate. In the money options deteriorate less compared to that of the out of the money options because of the extrinsic value. There you go. What is IV? Implied volatility. So we just spoke about it a while back. The market's expectations for the next 30 days. IV is implied volatility, and we spoke about it for a long time. So scroll back, check it out once we're done. So the Vega tells you the amount, the single percentage for every single % in IV, how much money will be added or subtracted from your overall options premiums. So that being said, we left out the last Greek. We call it RHO, rho. It tells you for every single percentage of interest rate hikes, how much money you'll be making or losing. That's it. I mean, we are in an interest rate hiking environment. If Federal Reserve raises interest rates by 1%, how much your contracts will be affected? Yes, it has an effect on your options contracts. If a Federal Reserve is increasing the interest rates by 1%, it's going to have an effect on your options contract. It doesn't matter if it's short term or long term. That will be taken care of by RHO, rho. The rho tells you the amount of money added to your premiums for every 1% increase in the interest rate hikes by Federal Reserve. It's one of the useless Greek out there, so that's why we didn't put it in, but something to know. So that being said, so if you guys have any doubts on this Greeks, on anything you guys want me to explain, let me know in the questions. I'm happy to answer. So now when you take a look at options Greeks, it won't be all Latin to you. So you will understand what it is all about. You'll know what delta is and what does it say, what gamma is and what does it mean, and what Vega is, what Theta is, which in turn helps you to get better in picking the right strike. So when you pick like way out of the money options, you know the risk, because out of the money options only got extrinsic value, and the theta only goes after the extrinsic value. You'll see more effects on theta decay in the out of the money options compared to that of the in the money options. So you know all these things right now, which is going to help you make better decisions when you're picking the strike prices. Does Vega apply to each or all the contracts you're holding? Vega, just like any other Greeks, changes for every single contract. Implied volatility for every single contract changes. So, for example, if 150 strike has like IV of 50% and the Vega of 0.06, 51%, like 151 strike is going to have a different IV and different Vega. 152 strike is going to have a different IV and different Vega. So it changes for every single contract, every single strike price. And IV changes for every single stock as well. So each contract or all the contracts, as long as it's of the same strike, then yeah, it's for all the contracts. If you have different strike prices on the same stock, different strike prices will be having different Vega, different IV. What contracts would you choose if you're scalping 0 day to expirations? Which one would move faster? Which one would move faster? Out of the money options actually moves faster, because the gamma is actually higher in those out of the money options. The gamma appreciates faster in out of the money options. These are some of the advantages of out of the money. But if you want like to make quick money and fast, just like that, out of the money options is what you go for. In the money options are boring. It moves slow. The gamma effect, you're gonna have it slow, but you make a lot more money for every dollar move compared to that of the out of the money options. But you'll make quick money when it comes to OTM compared to that of the ITM. Simple as that. So if you are doing 0 day to day expirations, and especially if you're scalping, your time frame is no more than 1 to 5 minutes, well, out of the money options are cheap, but not my style of trading. But I know a lot of people actually do that as well. So yeah, if you bought calls at 390 and change, right? Let's say the SPY low was 391.96 or something today, and it was also a support area. And let's say you bought calls there expecting the SPY to go up to like 393. You better hope it goes to 393. Let's say you pick the 393 strike expiring on the same day. You better hope that 393 spike happens within like 5 to 10 minutes of your entrance, because like if it's not going to happen, those contracts are going to deteriorate fast enough. Even if it goes to 390, you won't be making as much as money as you've been expecting to make, because the theta would have eaten away like almost like 3/4 of your contracts already. The more it trades flat, the more money you lose, especially with the 0 date expiration options. With 0 date expiration, you got to be right with time as well as price. You can estimate what the price will do with the probability, but you can never ever tell at what time the price will hit this exact number. It is impossible to do that. Anyone who's saying otherwise is absolutely lying to you. So simple as that. So at last, what is rho? So I just said like Federal Reserve increases the interest rates by 1%. Rho tells you how much of an impact it's going to be having on your overall option premiums. If rho is at 0.05, if Federal Reserve increases an interest rate by 1%, your contracts are going to go up like $5. So that's it. That is what rho is. It doesn't matter much because no one even keeps an eye out for it. Federal Reserve is slowly increasing the interest rates at this moment, but it doesn't have much big of an impact to your contract, so it's not worth to keep an eye out for it on a day-to-day basis sort of thing. Show me the money, as Jerry says it. All right, so like $3 away is okay. It depends on the position, depends on the price action. Strike selection in itself is an art. It's like it's going to take a while to perfect it, but most of the people trade like this. Let's say SPY is trading at 390 and the next resistance is at 394 and you're expecting the SPY to get there. So they will get the 394 out of the money strike, and once the SPY gets to 394, they will sell it. Once the contracts goes in the money, they will sell it. Simple as that. So you can trade like that as well, or some people just get the 385 contracts when SPY is trading at 390 and change and sell it when it goes all the way up to 394. You can do that as well. Totally up to you as a trader. Could you use resistance as a support for the analysis? Yeah, I mean, like I will talk about the basics of technical analysis in the next session, because as I said earlier, it doesn't come under the scope of this session. So if there is no other questions when it comes to Greeks, if you guys enjoyed this, leave a like, subscribe, check out the Discord, check out the Patreon. Link is down below in the description. And see you guys in the Discord, I guess. Thank you so much for joining. Thanks, Mario. I will go through the video when I'm paper trading on the paper account. Yes, perfect. Because the more you observe it with your own eyes, the more it'll make sense, sort of thing. These are all in paper, right? In paper, it might sound a bit complicated, but when you see it happening in your own eyes, it makes even more sense. The more you trade, the more you look at these data, and the more you see it happening with your own contracts, it's going to blow your mind. Trust me. Knowing all these is a big help. Without knowing these, don't trade options. Simple as that. Like, why will you even enter into something if you don't know how much money you'll be making or losing? Simple as that. Like, if you don't know how much money you'll be making or losing, you don't know how much money you're risking. If you don't know how much money you're risking, you have a shit risk management. And even if you made money out of it, it's of pure luck, then like it's a disaster waiting to happen. So these are all the basics which every option trader needs to understand. So yes, so this will be out. I will post the link. The link is in the Discord. So I'll post it in the newbies section in the Chris Saints Discord, and I'll post it in the learnings resource and my Discord as well. So you can check it out anytime you want. So thank you so much for joining. Really appreciate it. Leave a like, subscribe, check out the Discord, check out the Patreon. I will see you guys in the chat room. So if you have any questions, feel free to ask over there in the Discord. I'll be happy to help. Thank you so much for joining.